Now, more disappointing economic reports today on housing and on consumer confidence. Home values in 20 cities measured through April, they fell 4% from a year earlier. Also, a Conference Board sentiment index, it fell to 58.5. That was revised from 61.7 in May. So with all these negative reports, why are stocks on the rise? That's just one of the questions before our Taking Stock think tank. We have Jay Pelosky. He is a consultant at J2Z Advisory. He's also a professor at George Washington University, so he's smart. He knows what he's talking about. We also have Demir Gjokaj, real estate analyst at ITG Investment Research. Demir is a former housing policy advisor to the governor of Hawaii. And also we have Bloomberg Businessweek's economics editor, Peter Coy. Peter Coy, I'm going to start with you because, you know, you're the smartest of the bunch. Why does the stock market go up on a day when you get so much gloomy economic news and just the constant drumbeat of violence in Greece?
I have no idea. That's actually, I would think it would be going down at a time like this. But, you know, the guys who follow the stock market would have a much better idea than I do. You know, we had people smashing windows in McDonald's restaurants in Greece today, and people are concluding, oh, the passage by the parliament is a sure thing. I don't think it is.
Well, there you go. He's an economist there, or at least he plays one on television, Jay. Right. What is your take on it? He says he doesn't know. He would expect the stock market to go down, but no, it rallies.
Well, the market always likes to make the most people unhappy, right? And it did that probably today. But I think a large part of the reason why the market is up yesterday and today is that we've been flat to down for 8 weeks. So we've had a lot of time to digest a lot of this news. Greece is not new. The market doesn't like things that it doesn't expect, you know, that are surprises. And bad economic news, unfortunately, is not really a surprise.
So as long as we keep sort of drumming those negative headlines in, everyone will say, yeah, we expect it. It's not a big deal.
Well, and I think people are desperate to get up and to be up on the year. You know, we're 6 months in, we're at halftime, so to speak. Markets are roughly flat, but very few people that I talk to feel very good about their performance. And so I think the market's looking for an opportunity. I think a bounce is out there. The question that I have is how sustainable is it, and do you buy it or sell it?
All right. Demir, what do you think? You've been looking at the housing numbers. You specialize in real estate. What do you think?
Well, unfortunately, the sector of housing and construction is probably going to drag down a lot on that potential growth, the fundamentals of the economy. So when we look at the economy from a macro level, at this point, housing and construction, at least on the jobs side, should be adding a lot more than it is. And in fact, what's happening right now is it's a drag. So the way that I feel about it from the macro level, you look at this, we have growth. It's just downshifted to a much lower level. And at this point, we really want housing to be part of that growth, and it really isn't. It's absent.
Peter Coy, housing, at one point I was listening to Joe Brusuelas, Bloomberg economist, earlier today talking about how housing used to be about 6% of the U.S. economy. We're now down to about 2%. He says in some cases it just doesn't matter. It's getting to be so small. What's your take?
Well, that's actually a good point. It starts to be so small that it can't get much worse than it already is, and we're around there now. The problem is not so much on construction, which I think what Joe was talking about. That truly can't get down a lot lower than it is now. It's more the prices. The Yale professor Robert Shiller, who of course is the namesake of the Case-Shiller Index, is quoted recently as saying that he can imagine, it's possible to imagine house prices going down anywhere from 10 to 25% further. And if that happened, it would be a huge impact on people's wealth, and therefore their feelings about spending, and another drag on the economy.
Jay, what do you think? Another drag on growth if we see prices for real estate decline even more? Is there any prospect for a good second half of the year?
Well, I don't want to get mega bearish, but I think you can add to that the fact that the government looks like it wants to step away from the table in terms of, you know, if we're going to do anything on the debt ceiling, it's going to come with cutting spending. The Fed is on the sidelines now with QE2 ending. So one of my big concerns in terms of whether you buy or sell or rally or bounce in the stock market is I really don't see a lot of growth drivers in the second half. The one bright light that I see in the U.S. economy is manufacturing. I think that we're at the beginning of a boom in manufacturing in this country. The problem is it's only about 12% of the economy. The big bulk of the economy is services and housing and things of this nature. And if people's house values are going down and stock market values are flat to going down, they're not going to want to spend a lot.
So let me guess, sell into the rally?
Yes, I'm a seller into strength. And
seller into strength.
Yeah.
What about you, Demir?
At this point, I feel like the home builders have really gotten beat down a lot. There's a certain point at which the prices got to a level that appeared as if it was being priced for bankruptcy, really, and we really knew that wasn't going to happen given the Obama sort of tax carry forward that they enjoyed. So I can only really speak to the housing, the home builders, and the housing related.
So you say buy the home builders?
I like the home builders right now at these prices, and certainly in the last couple days they've been rallying. On today's news, you mentioned today's news and why they might be surging on today's news. It was also the first sequential increase that we'd seen. And you should have expected a sequential increase, but it was almost, I felt a sigh of relief go through the entire market. Oh, the seasonality is back.
A relief rally. I guess that's where they get the term, right?
A little bit of relief there. I think people saw the seasonality in the Case-Shiller number. It wasn't a big deal. I don't think it's overblown, but by the same token, it happened. And, we've actually seen a couple years where the seasonality didn't occur, and that's a little bit creepy.
Now let's bring in energy prices and find out how it all affects the marketplace. My guests are Jay Pelosky of J2Z Advisory. We also have Demir Gjokaj of ITG Investment Research, an expert on housing, and our own Peter H. Coy of Bloomberg Businessweek. Jay, you were talking about selling into strength, selling into rallies, and that the only bright spot right now, from your perspective, is the manufacturing sector in the United States. So what do investors do? Where do they park the money while they wait for things to turn around?
Well, it is pretty interesting, right, that the Fed has engineered this zero interest rate policy. So if you're holding cash, you're actually almost paying people to hold your cash for you. So cash has become really a problem for investors, and it's very hard to make money. I think there are several areas, though, where one can look. In housing, I like PCL, which is Plum Creek Timber.
Right, the Real Estate Investment Trust.
Right, 4.5% yield, so you get paid while you wait for housing to really demonstrate a recovery. In terms of the manufacturing, I like the ETF XLI, which I think will really benefit as these companies come to more competitiveness in the United States and the overseas demand remains robust. And then I think there are plays in fixed income and commodities as well.
Fixed income. With the 10-year at 2.3 something percent, I think, what is it? The 2-year is
there.
Right. Isn't the 2-year at 0.33?
Yes. Well, yeah, and that goes back to my point before. The Fed has engineered all this, right, to get people to take risk. Where I think the opportunity lies is at the long end of the Treasury curve, the 30-year bond at 4.2%. Last summer, we were at 3.5%. I think we can get close to that over the second half of this year and into 2012. And then I like emerging market dollar-denominated debt, which has great fundamentals, and yet the yield is about 6 to 7%. And I think that's an attractive opportunity for investors as well.
That long bond, that's got echoes of Gary Schilling. Let me bring in Peter H. Coy here. Peter, you hear what Jay is talking about in terms of the second half. Look for dividend-paying stocks because you've got to wait until things turn around. Is there any possibility that we'll get any kind of resolution in Washington over the debt ceiling that will include tax increases as well as spending cuts?
Yeah, I think that's got to be a possibility. Certainly the Republicans would deny that it's even a chance, but how else is it going to happen? Are the Democrats going to cave 100%? I don't really see that. I see some kind of a deal that involves some kind of compromise. I think the bigger fear, as one of those guys said earlier, is that what happens if the deal includes a lot of front-loaded budget cuts, which could actually hurt this fragile recovery. That's probably the enemy number one of the second half right now, is the chance of huge federal budget cuts in the short term.
Demir, I want to ask you about wage growth, because without any real wage growth, you have people that are faced with the difficulty of trying to get a mortgage. They can't get the mortgage because they don't have the money to spend, so it becomes a vicious circle. Is there any opportunity right now for, let's say, an extension of the payroll tax deduction, a 2 percentage point, that's the tax holiday right now? Do you think that that's likely to happen?
Not only do I not think it's likely to happen, I question how much impact it would really have to new home sales, at least, or even on the existing home side. It's become pretty clear that not only do you have to have the 20%, but you also have to have great credit. And you tend to get great credit by owning a home. So people who owned a home don't have a problem getting another home. But that first-time buyer is having a really hard time. So we haven't yet kick-started the chain from the bottom up. So I use KB Homes, who's reporting tomorrow, as sort of a bellwether. They're so levered to the low end of that market, the bottom end. They tend to be a bellwether for whether the new home, the first-time home buyer is coming back in. And at this point, the answer is resoundingly no. We haven't kick-started the change. So we've got a lot of buying and selling inside of the market, but we haven't brought new people into the market. market yet. And this is part of the demographic problem that plagues housing right now.
Peter H. Coy, this idea that Demir brought up about bottom-up economic growth, have we sacrificed that and thought we can engineer it from the top?
No, I mean, that's a good point. Any sustainable recovery ultimately has to be a bottoms-up recovery. That gets into the whole debate about role of Keynesian economics. But no, it can't be just the government engineering this recovery. Eventually, it's got to come from companies.
We got to leave it there. I want to thank you for coming to us, Peter H. Coy, Jay Pelosky, and Demir Gjokaj.